thank you to the EAPI team for having us here. We've obviously had a very nice presentation by Jeff with regards to the kind of high-level story, a macro story, and I think what this panel is going to give us an opportunity is to kind of hear from some of the industry practitioners and get into a little bit more detail. Preston, I'd like to start with you first. You're in this interesting space where you kind of sit with two hats. You're an investor with Rendeavor, but then you're also a master developer for Tattoo City, and you are, of course, trying to secure investors to come in to Tattoo City, into your master development. Given those two hats, how are you seeing kind of the trends in the market in terms of what investors are seeking, and do those align also with what you're trying to achieve as well?
Thanks, Raghav, and thanks to the fellow members of the panel and EAPI. I think the message I would have in response to that is if you don't have a Chinese speaker working at your company right now, start looking. We have seen just after Liberation Day and the Trump tariffs, a wave of Chinese companies, Asian companies more broadly, in interest in the market. Those are very positive trends, I would say, for Kenya. There are opportunities for those companies here, and there's a huge amount of job creation and investment that comes with it. In Tattoo City's case, we've been marketing to China and Asia broadly for the last 3 years. We're in dialogue with over 1,000 Chinese companies. We're home to the largest private Chinese FDI in the country right now, which has already created about 5,000 jobs in the last 18 months. So we know why they're coming, and in terms of market trends and what investors are looking for, that is absolutely number one for us. In other space, we see the continued growth of the call centers in Kenya. That would be like CCI at Tattoo City. We have additional call centers. There's other developers in this audience that have been the beneficiary of that. Kenya's in the sweet spot for global business services and call centers, and that's also something that we should be welcoming with open arms. I'll leave it with that.
Cool. And I think we'll come at a later stage just to delve a little bit into some of the other asset classes that you're seeing vis-a-vis the work that you're doing. Sandile, I mean, you're obviously here with a financing hat on. We've just heard from Jeff as well with respect to kind of the APSA outlook. He also talked about reducing interest rates. I'm imagining that APSA has, of course, started cutting down their rates on their loans. How has, kind of with that lens of this environment that we're seeing, which is, I think, very different from what we've seen over the last, I would say, arguably 3-4 years before that. How are you seeing the opportunities that are arising? What is the consideration vis-a-vis when you look at what is the yield that is being achieved on projects compared to what you are able to lend at? Because previously, I would say that I think many developers here kind of given me a nice segue, given that you've just mentioned offices. So I want to move along to your neighbor. Samir, you operate a successful co-working platform, but you sit as a manager, right? You're not there undertaking developments as such. Has the yield consideration vis-a-vis managing and operating a shared working space versus actually going ahead and developing an asset like that serves that purpose, is that something that has come into consideration? Or what has driven your thinking behind, okay, let's start with management, and then how are you going to see about maybe where you move the business model going forward?
Yeah, no, very, very much, Raghav. Just in sort of a little history to where we started, and it was a challenge thrown at me about 2017 through our family group, which is we're a local investor, quite heavy on real estate, hospitality, office, commercial, retail, that sort of stuff, and an investor in ABSA. So just in the perspective of a local investor and yield, so across not just real estate but other asset classes, the challenge was when you compete, for example, like I told, treasury bond, the infrastructure bond, sorry, yeah. What is it that we could do that sort of is yielding close to that, or in excess, frankly, for all their time and effort of putting this in. So we did a fair amount of research. We had JLL do feasibility for us, et cetera, and this is where we landed. In 2017, the opportunity was much smaller than we see now, but from a yield perspective, we do more than twice what I read the typical Kenya shilling yield on traditional offices. We, depending on occupancy, we go even higher. We can get to 30 or even 40%, and that's in US dollar. So that was the appeal, yeah. But I think it was an experiment. It's still very much an ongoing experiment. The pushback constantly from within the group and outside, including the banks, is where's your asset? We lease space. I think there are different models. There are those who, Blackstone, for example, owns the office group that's about 3 million square feet in Europe of owned and managed flex office. There's Industrious, whom CBRE recently acquired, at the other end of the spectrum, who are almost all management contract. We've been looking and sort of trying to sort of chart where our trajectory might go. I think we've ruled out management contracts because we don't feel there's enough scale relatively in our markets to justify. There are others who are doing it. The biggest in the world, IWG, is very much on that now. So we feel going forward will be a mixture of lease and owned assets. In terms of owned assets, it's existing stock that we feel we could acquire at decent values and transform into what we do. So I think it will be a mixture. And yield, when we apply it in those cases, is again significantly higher than it would be on a traditional office.
But so clearly I'm in the wrong space if you're talking about double the yield. That I think you might be facing a lot of competition from this audience now going forward. But I mean, what's interesting is when you talked about ownership, you actually talked about acquiring existing assets. So is that a conscious decision that you don't want to move into development? You want to essentially look at repurposing existing assets, is it?
Yes, yeah. I think from I think an opportunity perspective, we see opportunity. I think in the context as well, without sort of getting carried away with it, the things we track are the penetration rate. So in the office context, what portion of it is flexible? And flex means a lot of different things. You have kind of the image of co-working, which is the sort of the roots of it. The entrepreneur, the freelancer. You've got the other end of the spectrum, which is much more corporate, much bigger space. It's customized space. It's for very big organizations. I mean, Goldman Sachs use it, for example, in the US. So, across that whole spectrum, there's a whole bunch. But I think the opportunity is with existing assets. In terms of taking the development risk on building, et cetera, I think we see. Sorry, I meant in terms of not getting carried away with it, is scale. So I think that's an issue that we constantly face. How big and kind of fully recognize what we currently do is a very slim portion of the entire market. So it's the highest yielding. It's dollar paying. We're heavy on capex as a result, et cetera, et cetera. But how big is that market? It's probably, by our estimates, maybe 5%. But I was sort of talking about the penetration rates. So we estimate Nairobi at roughly 7%, which puts it kind of on par with New York or London. It's good. It's in terms of good for us, and people recognize what we do and have accepted it increasingly. But I think the opportunity, I see Wayne sitting there. I mean, I reference JLL on this all the time. So they started it, and we talk about it. So in 2021, they predicted that 30% of all office stock by the year 2030 would be flex. So potentially you're going from 7%, it may not get there in 2030, but something in between. If I watch India a lot. India is now close to 20%. It's almost 100 million square feet of flex space in India. And a lot of that growth came in just over the last 4 years. So not necessarily that will apply to Nairobi, but I think there are bits that kind of we're positive. We do see room.
I see the smile on Wayne's face, and I hope he doesn't have equity ownership in this. Preston, over to you. Vis-a-vis Tatu City, I mean, Samir's just kind of really talked glowingly about this, shared flex workspace. You referred to, obviously, some major developments, major projects that did have been launched in Tatu City with respect to CCI, the call center. Is the model that at Tatu City to continue looking for operators potentially who might be operating, coming in to do flex space? Is that something that is part of the thinking? And aside from that, what are some of the other areas that you might be looking at, other products or asset classes? Because I know with Tatu City, let's say historically, there's been a focus within residential and industrial. But do you see, as you evolve the master development, that there's scope for other products to come in?
Yes, definitely. Starting with the flex office space, at Tatu City, we have Gateway Real Estate and Grit, which has some there and is expanding that. In terms of what we need more of at Tatu City, it is in the call center space. So that's either developers like Gateway and Grit doing that themselves in partnership with us doing it ourselves. And I think that is, although it's commercial office space, it is quite specific to the BPO market. And maybe I would ask Samir, I was curious, have you had anybody come, let's say, from the US and say, I need 50 seats, I need 50 desks, and you're able to serve them?
So actually, we saw it start in sort of 2021, still COVID affected. And that momentum is definitely building. So they asked when we started, they would sort of configure it. We had 4-person office. The biggest was a 14-person office. Yeah. We now do space for 100 because of the demands, and most of it is from BPO of some sort. Yeah.
So I'd say there are dozens and dozens, at least more than 25 companies now in Kenya that are taking 50 desks, and they're dipping their toe into the market, looking at what CCI has done very successfully with Gateway and Grit, and wanting to tap into the amazing Kenyan workforce, which is now, I would say, recognized as one of the leading, if not the leading, BPO workforces in the world. So you have these companies coming, they want to dip their toe in with 50 desks. They will go into an existing building, but they scale very rapidly. They can go from 50 to 600 in a couple months. But then they get to the size where they need something that is bespoke, and that is what CCI has done at Tatu City. So those kind of buildings that are built for BPO, Kenya will have hundreds and hundreds of thousands of BPO jobs over the next decade. And the current office stock is not suitable for that. So I'd say, is it a different asset class? Potentially for commercial real estate. Other ones that we look at Tatu City are schools. So the school space, I think, continues to be very interesting. Both the schools at Tatu City have been oversubscribed from day one. They have a very good price point, and they are all expanding, and they have waiting lists. And we are bringing additional schools into Kenya at Tattoo City, and we're also doing the same at and we're doing the same with universities, tertiary education in Kenya. Another one I think is healthcare. Now this would be decentralized healthcare. This is one where I really would challenge one of the developers in the room or funders in the room just to think in terms of all of the new healthcare builds are generally central Nairobi, Ngong Road, Parklands, Westlands. Kiambu County, we would welcome you, has a population of 2 to 3 million. Its GDP is larger than Rwanda's. So hats off to AAR for developing a fantastic hospital in Kiambu County, but there is definitely room for more. I think that's another one we would look at.
What, just a quick follow-up. What about, I mean, the flavor of the month, I would say, for the last couple of years has been data centers. Is that something that has come up in a conversation with you?
Yes, it certainly has. We've got very good discussions with data centers. We had deals that advanced up into the point where ChatGPT came into being, and they all had to pull back to European and US markets to focus on those investments there by their clients, Microsoft, Google, Meta, et cetera. They are all back in full force. There are quite a few data center deals on the market currently. In our case, we engineered Tattoo City to be ready for data centers, to be a data center cluster. And that is because of the power network we have. We have three 66 kV lines, independent lines that come to Tattoo City. And the amount of redundancy, we have a 99.7% power uptime. So that's how we've readied ourselves, and I think you'll see some news in that space.
I've seen Julian's nodding his head, so I'm assuming my time is running out. Although, by the way, I've got 0-0 from the beginning out here. Huh? 5 minutes, okay. Sandile, Abdi in his presentation talked about sustainability financing, right? So I just want to kind of close the loop on that. Given that you're out there looking at deals specifically, how are you, as a bank, having ESG manifest itself in the deals? How are you watching out for, I was on a panel yesterday there where I kind of referred to greenwashing. How are you watching out for the avoidance or the mitigation of greenwashing? Because right now, it's kind of the flavor of the month as well, and everyone's talking about it.
Sure. I think everyone can acknowledge that over the last 5 to 10 years, ESG has gone through a major evolution. It started off as a buzzword, then the focus shifted to the E, being the environment, given climate change, global warming, and that will continue to play out. What we are seeing now in the market is a greater emphasis on the S, whether it be community upliftment, access to essential services, affordable housing. So we are seeing a lot more activity around that, being the S, which is imperative, right? I also see, encouragingly, how investors, developers, government and government agencies are collaborating with banks to see how we can solution for the dire shortage that we see across our markets. So definitely, I see it beyond, it's progressed beyond the greenwashing, which I think did take place, and we're now seeing a fuller appreciation for the definition being ESG.
Just a quick follow-up, because the bit that you focused on, the S, is actually a pet project of mine as well. I know in the previous organization that I was working at, it was something that I wanted to try and see if there was a way to execute that. How, just for everyone's benefit, particularly you as a financier, what are the types of instruments that you're thinking of or working with in order to bring out that social element?
So I suppose the one bit is us being more bullish around that segment, us taking a more aggressive stance around structuring. I suppose the challenge is, as a bank, we don't necessarily have a separate source of funds that speaks to supplementing that sort of pillar, but certainly from our perspective as commercial property, we are taking a more bullish stance around the S.
Last one for Samir. Given that I think everyone's thinking about those 2 times yields that you talked about, I know it's just been going through my head. What do you think, and I also refer to this because just a few days ago I actually was hearing from someone how they were in a shared office space and actually the operator has asked them to vacate because they're downsizing the amount of area that they've taken up. So just so that I can move into the business plan straight after this panel, what makes a successful operator versus what are some of the challenges or pitfalls?
Yeah, I think we've counted over 70 spaces in Nairobi. I'm sure there's more. That's just 70 we know of. So there's lots of it. I mentioned the penetration rate, etc. So I think our approach was quite methodical and heavy in sense of taking advice, understanding as far as we could what we were trying to get into. But I think going forward, differentiation is critical. So understanding who this is for. I mean, like Preston said, call center, etc. They're quite different needs. When we've looked at it, it's not a sort of one size fits all. Understanding price points, affordability, whether it's Kenyan shilling or USD. And increasingly what we do is sort of not on the social side, on the experience side. And that's heavy lifting. I sort of came from hospitality hotel background, so it didn't maybe occur to me when we started doing this that this is not what you do in the office environment. But curating that office experience is it's not just desks and chairs, and I think getting that right, a whole bunch of stuff. It needs a lot of time and effort, and I mean it's a relatively new industry. It's dynamic, it's changing, but yeah. So I think there will be probably some consolidation in our space. I think out of that 70 odd. Interesting to refer to India as well. India is dominated now by 8 big ones. 7 are Indian and 1 is WeWork India. Interestingly, WeWork India is the first part of WeWork to be profitable, was the first part, and growing. I mean, they added almost 3 million square feet, just them last year. So I think you will sort of see consolidation. So I think understanding what you're doing this for, I mean, there's a lot of moving parts that go into it. Distribution, big one. We try and solve that ourselves. It's probably my biggest headache. How do you solve that? Yeah.
Very cool. I think our time is up. So I think from our side, a few key takeaways. It definitely sounds like things are humming and revving up. I don't think maybe we're in the same position economically as last year. Clearly, the banks are looking to lend. So I know there are a couple or probably more. Please go speak to them. I think the other thing I would say is that if you know what you're doing, make sure you differentiate yourself and make sure you kind of just go hard at it. That's what I've learned. And then the last thing is brush up on your Mandarin. CC.